Hey guys, OPSEC here, and today we're going to be talking about what are longs and shorts and why do they even exist. Okay, so longs and shorts are pretty much futuristic contracts that allow you to place a deal in the future. Now, why do they exist? Well, back in the 19th century, let's just say you were growing a field. It was just now the Industrial Revolution, and let's just say you had a field and you were growing corn in that field, right? So you probably have a big field like this, and you're growing corn in the entire field. Okay, so you're pretty much a corn supplier. Okay, and the people who are buying from you are probably corn manufacturers, right? And they sell corn to the retail. So they probably manufacture, let's just say, cornflakes, cereal, pretty much breakfast cereal, and they use corn to manufacture it, and they sell that to retail. So let's just say you have a farm, right? You're a farmer, and you're pretty much a supplier, and then there is a manufacturer, and he has like a nice little warehouse, right? He's the manufacturer and he sells to the retail. Now, in this relationship between you and him, you are gonna be the seller and he's gonna be the buyer. Okay, so let's just write over here S. Right, you are the seller. Here, let's just write here seller, and he is the buyer. Okay. Now, let's just say corn rots after, let's just say, 1 month. Okay, so if I were now this guy over here, the guy who sells to retail, then if I were to buy a supply of corn, then in 1 month I'm gonna have to buy more, and I'm not sure what the prices are gonna be in a month because many things could happen. Maybe less rain or some shit like that, and then there's less supply, and then price goes up. And that directly affects my customers because my customers want stable prices. They want to know what the price is going to be. Or maybe my competition might be able to get corn at a lower price and then they can offer it at a lower price or whatever. Basically, the longs and shorts came in because they needed to place down a futuristic deal. So he wanted to, let's just say, guarantee he has supply for, let's just say, for simplicity's sake, let's just say he wanted to guarantee he has supply for 2 months at a consistent price. So what is he going to do? Well, here is where the longs and shorts come in. So what he's going to do, he's going to buy supply for an entire month. So let's just say he needs 1 kilo of corn and that's enough for an entire month. And then he will place a futuristic deal to buy another kilo in another month, and that will sustain him for 2 months. Okay, so so let me show you how it's gonna look like. So the way it's gonna look like is the seller is gonna have to place a short, because short pretty much means he agrees to sell in the future. So let me show you how that's gonna look like. It's gonna look like this. Short. Let's just change this to 16. Okay, so short. S, like S for seller, agrees to sell 1 kg of corn to B, that's the buyer, at the price of, let's just say it's $10 per kilo, okay? And there has to be a specific date attached to the contract, okay? And on that date, the contract is going to take place, the deal is going to take place. So let's just say on the 1st of February, okay? Okay, because let's just say now is the 1st of January, so that's going to be on the 1st of February, okay? This is how it's going to look like on this side, okay? Now on this side, if he agrees to sell, somebody has to agree to buy from him, right? Each short has a long attached to it, so there's going to have to be a long on the other end, and that's going to be like this. Long, B agrees to buy 1 kg of corn from S at $10 per kilo on the 1st of February. So now on the 1st of February, whether price goes up or down, this deal is going to take place. He's going to buy 1 kilo for $10. Okay, so on the 1st of February, this exchange is going to take place. He's going to give him 1 kilo and he's going to give him $10, and that's how it's going to be. Let's just say, hypothetical scenario, where 2 weeks in, and price has just risen up to 15, and the seller thinks it's going to continue going up. He doesn't want to take any further loss. He's already lost $5 because he's pretty much selling to him, right, supply that he has just now because it just grew. So he's selling to him supply that's worth $15 per kilo. he could sell it otherwise for $15 per kilo, but he's selling to him instead for $10 per kilo. So the seller is going to be losing over here, right? So if prices are currently at $15 per kilo, and you sell it for $10 per kilo, you're a sucker. And this guy is gaining, right? Because then he can just sell it back to the market at the higher price, at the current price, and realizes $5 profit. Let's just say the seller thinks prices are gonna skyrocket up to like 20, and he wants out of the deal. He cannot cancel the contract. The contract is always gonna be around. But how does he close the deal, and how come I can close a long or a short? Well, the way he does that is pretty simple. It's called novating a deal. It's pretty much applying the equivalent pressure from the other side, right? Because if you push let's just say, imagine this. You have a wall. Here, let's just draw it like this. Let's just say there is a wall, and it's being pushed. Here, let's take an arrow. It's being pushed with 10 kilos pressure, and it's slowly moving. It's moving at a certain pace, and it's slowly moving because it's being pushed 10 kilos. All it needs to stop is an equal and opposite force. So if 10 kilos come, then it's going to stop. It's not going to move back to where it was initially, right? But it's going to stop at that point, right? So how do we apply this over here? Well, if he shorted 1 kilo, we're not looking at the price, we're just looking at the quantity. If he shorted 1 kilo, to cancel it, he has to open a long of 1 kilo, okay? Now, this long can be with anybody in the market. It does not have to be specifically with this guy, but for simplicity's sake, let's just say it's with this guy, just for simplicity's sake, so I don't have to draw in like another guy. But that's the beauty of the market. It can be with any other guy. So it's going to look like this. S agrees to buy 1 kg of corn from B at $15 per kilo. The price has to change to the current price. And the date has to stay the same, on the 1st of February, okay? And then let's just say this is the guy who agreed to short for this long, right? Because there has to be a short for every long and a long for every short. So it's going to look like this here. B agrees to sell 1 kilo of corn to S at $15 per kilo on the 1st of February. Now, what's going to happen on the 1st of February is going to be this. He's going to give him 1 kilo of corn. He's going to give it back, okay? That is this short eliminated and this short eliminated. And then the long is, right, so this is 1 kilo back and forth. So it's right back where it ended. Then this long means he's given him $10. So he gets $10, but then he gives back $15. So he gave a kilo and got it back. So we can X that out. And he received $10, but he gave back 15. So he's at minus $5, right? Because he received 10 and lost 15. So 10 minus 15 equals minus 5. And this guy gave 10, but received 15, which equals 5. So this guy's in $5 profit, and this guy's in $5 loss. And that's how longs and shorts work. Now let's get this on the graphs and show you guys how this actually looks like. So let's just draw a hypothetical graph. Hypothetical chart. Okay, so let's just say we have it like this. Right, so we have a chart right over here. And let's just say price is moving here. Okay, so let's just say you enter along at this very point, at this step, okay? And let's just say price over here is at $5, okay? And over here price is at $10. Up here and up here, okay? So, and up here price is at $10, okay? Let's just say you enter along over here, okay? How would you cancel it? Like, the contract is there forever, right? How do you close a long? Well, this is something many don't know. When you close a long, you're actually opening a short. So pretty much, if you open the long here at $5 and you're taking profit at $10, you pretty much open a long here and then you open a short there. Now let me show you how this looks like behind the scenes. So you buy one contract, so long 1x, so long and then the quantity, which is 1x contract at 5, then short, and then if you want to close it, then you short one contract at 10. Now let me show you how this works. So now if you're long at $5, price moves up to 10, you're currently at $5 profit. Now you short at $10, okay? Now if price goes up here it's at 11, let's just say, up here it's at 11. So now when it's at 11, your short is now in a $1 loss, but your long is in a $6 profit, right? So you're still at $5. Okay, so at $10, short, so okay, at 10, short 0s, long plus 5, okay, equals plus 5. And now at 11, short minus 1, long plus 6 equals plus 5. What do we see? Longs and short cancel each other out. Now let's just say price dipped over here. Over here it's at like 6, okay? Down here it's at 6, okay? So let's just do at 6. Let's see what happens at 6. So at 6, the short is at plus $4. And the long is at plus $1, which equals still plus 5. So now, what do we understand from this? We understand from this that given that the quantity is the same, a long and a short will cancel each other out. They're equal and opposite forces. They cancel each other out. If you open a long and a short at the same place, you will remain with 0 profit and 0 loss. If you open a long and then you open a short later on, once price has moved, whether that is to the upside or to the downside, then it will realize your profit over there. Whether it's when it hits your stop, you open a short, or when it hits your take profit, you open a short. And same with shorts. If you open a short and then you close it, you're actually opening a long. So when your short hits the take profit or the stop loss, then you're opening a long and you're buying. That is why when we hit stops of shorts, that's called buy stops, buy side liquidity. And that's why when we hit stops of longs, that's called sell stops, sell side liquidity. Okay? So that is how longs and shorts work. And that's how they operate behind the scenes. Exchanges use longs and shorts as a currency. So if you give your exchange one long at $5 and then you give them one short at $10, then you receive back $5. If you give them one long at $5 and you then later give them a short at $4, then you lose $1. Okay, so that's how longs and shorts work. I hope you enjoyed this video. I hope you enjoyed this explanation. Share it with a friend who needs it. Peace.